Gotcha. Gotcha.
Yo, it's Wolf. I'll be showing you how to identify and mark up your supply and demand zones in the Forex markets, commodities, and stock markets as well using Tradingview. Take notes, listen, and have an open mind, all right? So look, right now I'm on a gold chart. That's XAU USD. And again, I'm using Tradingview. If you don't know what Tradingview is, just Google it. Simple. There's an app. There's also a website. So look, listen, it's very, very simple. You're just going to pull your rectangle tool out. That'll be at the left side of the website. So you're just going to come over here to the left. You're going to click this little arrow. That'll bring down a drop down menu. And then you're just going to click the rectangle tool. So the reason why you're going to need that is because this is what you're going to use to draw on the chart to mark your supply and demand zones. So how does the market create supply and demand zones? So basically the market will drive price either up or down, okay? And when price goes up, it's going to come to a point where there's too much supply and there's not enough demand. So then price needs to drop down and vice versa. So if, let's say, the market is trailing downward and then that creates a lot of demand, right? But there's not enough supply, then that is going to shoot price up. So when you see the market trailing downward and then you see price shoot up, there is a demand zone somewhere in there, okay? So I am going to show you exactly how to identify those, and I'm going to show you exactly how to draw those up on your chart so you can find your entries. Simple. So first thing you do is you identify the trend. You're going to always identify the trend. So all you got to do is zoom out. That's it. In Forex terms, it's bearish. So when you see the market is going downward like this, we call it a bearish market. If you see the market going up, then we call that a bull market. So from this point on, we see that the market was bullish, right? And if you come to the 15-minute time frame, it's going to look a little bit different. There's going to be less candlesticks. So let me break down what candlesticks are. So each box that you see right here is a candlestick, okay? Right now I'm in the 5-minute time frame, so all that means is every candlestick is 5 minutes that have went by. All right, if I go to the 1 hour time frame, every candlestick is an hour that has passed. Simple as that. So from this point on, you can see that the market was bullish, right? And then from this point on, you can see that the market was bearish, right? Simple as that. Simple as that. Simple as that. Okay, so now you know what a bear market is and you know what a bull market is. You know what supply and demand is. Now let me show you exactly how to identify that in the market and draw it up with boxes. This would be considered a demand zone right here. All right, this would be considered a supply zone. I'm gonna let you analyze this for a second and take a guess at how I came about drawing these boxes. Okay, that will be the last bullish candlestick before price started to trail down, right? So I started there and then I brought it up to the top wick of this candlestick. That's all I did. That's all I did. That's all I did. So whenever I mark a supply zone, basically what I'm doing is I'm waiting for after price comes crashing down, I'm waiting for price to come back up to the zone, and then that's where I look for my entries. Then we also can get into fair value gaps. This will be a fair value gap right here. That's for another video. I'm just gonna keep this about supply and demand, but this will be a fair value gap. This would be somewhere that I would be targeting if I had gotten to a sell around here. This is a potential target point because there's a fair value gap. But again, I'm not going to get into the details and all of that. That's for another video. So basically I would be waiting for price to come back up to this point, and then I would be looking for a sell. So you could draw up demand like this, or you could draw up your demand like this. It's up to you. So you can bring it up to the next candlestick's wick, or you can keep it just like this. It's totally up to you. But I would do it like this just because this is too big of a box for me. That's just way too big of a zone, to be honest. For me personally, for my trading style, I just wouldn't do it that way. You would get a less risky trade if you were to make your boxes smaller, just because then your stop losses would be much smaller as well. And we're all about risk reward. Risk management is the most important thing when it comes to trading. So I would recommend a box like this rather than a box like this. So mine would look like this, right? And then again, like here's a supply zone here, and the reason why I didn't bring this box way down here to the next candlestick's wick is again because it's too big of a box for me. I like a box like this. I would have drew my box from this last bullish candlestick before the drop, right? From the bottom wick to the top of the wick. And then when price came crashing down, I would have waited for the market to bring the price right back up to this level here. I would have extended my rectangle, and then I would have just simply waited for the market to approach this level again. At 1320 on a 5-minute time frame, that is when the market tapped back into this supply zone. So what am I looking for? Not buys, I'm looking for sells. Remember, when the market approaches a demand zone, you're looking for buys. When the market approaches a supply zone, you're looking for sells. It's very, very simple. As soon as the market would have brought the price up to this level, I would not have gotten to a sell immediately. I would have waited until this candlestick closed. Okay, so what do I mean by that, right? So basically, I would have waited for the 5 minutes to pass. Right? Once that 5 minute passes, then the next candlestick will form. Once this candlestick closes, the next candlestick starts to form. Once I would have saw that the market had tapped into this supply zone, but we didn't close in the supply zone, we closed right below it. That would have been an indicator that the market is about to drop further. This is where I would be looking to get into a sell at, because I see that price drop down. We created our supply zone, then it tapped back into that supply zone, but it didn't close within it. It closed beneath it, and then the following candlestick started just crashing down immediately. So we would have actually gotten into the trade on the third candlestick. Our first, indication right there to look for a sell, right? We saw it tapped in, closed up beneath it, and then we saw the second candlestick tapped into it, and then it also closed beneath it. So that was our second confluence right there, our confirmation. And then we would have entered into the sell right at the open of this third candlestick here. You are going to have more wins than losses as long as you just stick by the strategy and don't deviate from it, and get better and better and better with your discipline. But this is what a 1 to 2 would look like, and you can see here in the box it says risk/reward ratio 2. Okay, so this is what a 1 to 3 risk reward would look like. But yeah, that's how you identify and mark up your supply and demand zones. Simple as that. You have a blessed one. Peace. I'm out. Stay safe.